A very good morning. I am Neelam Jha, ex-Chief Manager, Faculty, Central Bank of India, and today's session is on technical write-off by banks, an inside story. I would like to begin with former RBI Deputy Governor K.C. Chakravarti questioning the practice of technical write-offs, stating such write-offs are scandals that create non-transparency and destroy the credit risk management system. He goes on to say that from 2001 to 2013, banks had written off around 1 lakh crores, and majority of these write-offs were for large borrowers. Against the background of this statement, let's analyze as to what happened after 2013. See, over the past decade between 2014-15 and 22-23, Indian banks have written off loans of rupees 14.5 lakh crores. Yes, you heard it right. Rupees 14.56 lakh crores to be precise. And this huge loan write-off aided banks to bring down the GNPA, that is gross non-performing assets, to a 10-year low of 3.9% of advances in March 2023. The GNPAs of banks fell from rupees 10 lakh crores in financial year 2018 to rupees 5.5 lakh crores by March 2023. Never seen such a steep fall in the GNPAs. I can see a comment there by Stuti. She says, good for the banks. Well, yes, in a short-term perspective, but for a bigger picture, there are concerns. Now, look at the amount actually recovered from these accounts in the last 9 years. It is just rupees 2 lakh crores, a mere 14% of the total technical write-offs. So, what exactly is a technical write-off? As per RBI guidelines and policy approved by bank boards, the non-performing loans, including inter alia those in respect of which full provisioning has been made on completion of 4 years, are removed from the balance sheet of the bank concerned by way of technical write-off. I will explain it through an example. Let us assume you have taken a loan of rupees 10 lakhs from a bank but are unable to repay. From the bank's point of view, the loan is an asset and the interest that would have accrued from you is income, right? Okay, I can see a question there. Yes, for a bank, the loans are assets as they bring income, whereas deposits are liability as banks have to pay interest to the depositor. So, in the bank's balance sheet, the loan amount will be shown as an asset as long as your account is considered normal. But if you are irregular in repaying the monthly installments, obviously the bank's revenue will come down due to lack of interest payments. Since the bank is still hopeful that you will pay back the money, the loan amount remains as an asset in its books. But beyond a point, as per RBI norms, if there is no income coming from an asset, the bank will have to first make provisions for this loss and then eliminate it from its balance sheet. This process of declassifying the loan as an asset in the books is write-off. So, as per RBI, the technical write-off refers to cases where the NPAs remain outstanding at borrower's loan account level, but are de-recognized by the lenders only for accounting purposes. Theoretically, such write-off does not result in waiver of liability of borrowers to repay. But the trouble is, while this is true in theory, it doesn't easily work in practice. I can see a question coming from Rekha. She says whether writing of loan is same as the waiving of loan. No, not at all. See, the waiving of loan refers to releasing the defaulter from the liability to pay the debt. For example, the loan is waived off in certain circumstances, such as during a natural calamity, the farmers are waived off on their dues by the government as a relief measure. Another difference between the two is that the decision of waiving of loan is taken by the government, while that of writing of loan is taken by the bank's boards. So, how does a technical write-off help the bank? It helps in balance sheet cleanup, making them more attractive to investors and shareholders. Secondly, it leads to enhanced risk management practices. Thirdly, they can now have a more focus on recovery, because after writing of loans, banks can continue their efforts more vigorously to recover the outstanding amounts without the burden of these loans affecting their financial ratios. And fourthly is the important point of tax benefits. See, the losses incurred due to write-offs can be offset against the profits, reducing the tax liability. So far so good. Now let's discuss the downside of technical write-off as to how it impacts the credit culture. See, despite the best effort of banks to assess the exact creditworthiness of the borrower before lending, some loans tend to turn toxic, either due to changes in the external business environment or due to borrowers' own internal constraints. But more worrying is the behavior of willful defaulters who have the resources to repay loans but are unwilling to do so. And writing of loans without following the due procedure sends a message that borrowers may not have to fully repay their loans. This can lead to a risky behavior among borrowers who believe they can escape the repayment consequences. And it may lead to a perception that banks are forgiving loans without holding borrowers accountable for their repayment obligations. This can adversely affect the credibility of the banking system. And most importantly, indiscriminate write-offs of big defaulters can lead to a public criticism, as taxpayers might perceive that banks are using public money to cover their losses. So, while loan write-offs offer advantages such as balance sheet cleanup, capital optimization, and enhanced risk management, they also raise concerns about moral hazards and lack of accountability. Striking a balance between addressing the bad loan issue and maintaining responsible lending practices is crucial for the stability of the banking sector and the overall health of the economy. There cannot be any scope for complacency regarding the credit appraisal and credit management procedures. I can see a question from Sia. She asks, is this due to AQR? Well, AQR, that is the Asset Quality Review, was undertaken by RBI to encourage a proactive asset quality recognition by banks. RBI ended forbearance in April 2015 and then started the Asset Quality Review for 6 consecutive quarters with the intent to have a clean and fully provisioned bank balance sheets by March 2017. It led to surfacing of huge chunks of bad loans, and the write-offs during that period make sense. But what about the last 3 years? Banks wrote off bad loans worth over 2 lakh crores in financial year 21, then 1.75 lakh crores in financial year 22, and rupees again 2 lakh crores during the year ended March 23, as per the RBI reply to a right to information query. And now look at the numbers of the recovery. It was 30,000 crores in FY21, 33,000 crores in FY22, and 45,000 crores in FY23 in technically written off accounts. Very dismal recovery, one would say. See, there is an urgent need to look at the low recoveries in written off accounts. By merely saying that technical write-offs do not entail any waiver of claims against the borrower and the lender's right to recovery is not undermined in any manner is not going to help our economy. Because in written off accounts, there are factors like complications in realizing the security assets as non-operational or under construction assets. They face diminished marketability. The point is that most of the written off cases, they are operationally weak, and in many cases, resuming operations or completing projects requires a huge working capital, which adds up to the complexities. This massive technical write-off of corporate bad loans is pinching our economy. We should not be looking at a band-aid type solution. The need of the hour is a panacea against the ills of this growing amount of technically written off corporate loans. Look, you all would have seen the photographs and addresses of smaller borrowers who have defaulted being published in newspapers before auction. But when it comes to borrowers with outstanding of over 100 crore rupees and above and their accounts being written off, the lenders take the plea of statutory and regulatory obligations to maintain the confidentiality of customer data. See, one of the criticisms against the write-offs is that they tend to encourage default behavior, as the costs of default are borne entirely by the lenders. And although the lender's right to recovery is not undermined in any manner, but the fact is that recoveries in technical written-off accounts has been hardly 15% over the years. And also there is a sense of inequality in written-off accounts. You would find a fewer number of small ticket loans. Most of them are big loans, and the smaller defaulting accounts are many a times not given the same leeway that the bigger ones are privy to. Perhaps the time has come to revisit the rules of technical write-offs and to strengthen the process of recovery mechanisms instead of diluting them. More transparency, accountability, and better checks and balances are needed. At least the shareholders of a bank should know the beneficiaries of large write-off accounts. After all, at the end of the day, it is the taxpayers' money at stake. With that, we end our session today. Thank you all.